Um, Good evening, everyone. Can any one of you confirm that you can hear me before I start the class?
Loud and clear, sir.
Yes, sir, we can hear you, sir.
Yes, sir. Yes, sir.
Great. So good evening once again. Today we are going to start group account, and we hope to finish it in maximum of 6 classes to finish the principles of group account. Then we'll have done everything that needs to be done so that we can go back to ratios and EPS, as well as sustainability reporting. These are the few things we have left. So we have very little to cover for this your class. But let's quickly take away group account. So the first thing I want to mention is not defining group account, but why do we have to learn this? Why are we even talking about group account in the first place? So the first thing we need to do is to have a context behind preparation and presentation of group account. So the context is that there is something we call intercorporate investments. Without intercorporate investments, we will not even be talking about group account at all. So it makes sense to start from there so that you understand where we are coming from. So intercorporate investment arises where one entity invests in another. And there are a series of examples of that. You have all these, in Nigeria, we have seen Access Bank buys shares in a lot of companies. We have seen a lot of startup get investment from angel investors, from all these investment companies buying shares in them. And we have seen Facebook buying existing companies and so on and so on. So intercorporate investments, one company investing in another company. And why are people investing in another company? Why can't they just invest in themselves and just go instead of investing in another company, buying another company? Why can't they just inject that money and do that thing they see in that other company and do it themselves? Well, that's another way. I've seen companies do that, like Google. When Google saw the rise of ChatGPT, even though it's unlikely that ChatGPT would accept, but Google didn't approach ChatGPT, but rather they actually went on to develop theirs instead of saying they want to buy ChatGPT. So they invested in their own AI arm and they developed an AI extension. Now, when you Google search, it gives you something similar to what you get on ChatGPT. What's the name of that their own? Can't remember.
Gemini.
Yes, Gemini. Thank you. Even Microsoft also did theirs as well. They also built in their own AI search engine like that, and on and on. But let's leave all that stories alone. Why did they do that? First is entry into a new market. Entry into a new market. So the reason to a new market very fast, very, very fast. So the reason why you would just, okay, instead of me taking a lot of time building this product, why don't I just buy a already developed company that is doing the same thing? So I can break into this market, into these new markets. People do intercorporate investment for that reason. And another one is tax planning and management. Some people, they purposely invest in another company just so that they can shift profits, or just so that they see that that entity is in a jurisdiction where tax rates are low and is investment friendly. So they invest in companies for majorly that reason, so for tax planning and management. Other one is to investment of surplus funds. Some people, they have a lot of money and they are looking for where to invest it. They just invest. Some people is portfolio diversification. They just want to have a balanced investment portfolio. Now, okay, let me invest in another company. Let me invest in another industry, just so that their eggs is not in one basket. That's why some people do intercorporate investment. Others would be for financial returns. Some people invest majorly for financial returns, whether to get dividend, interest, returns, regular returns. That's why some people would invest in another company. Others is just because of strategic control and influence. Because when you invest in another company, it can give you control of that company. It can give you significant influence over that entity. Like Otedola buying shares in First Bank. From the first day he was buying those shares, his aim is that he wants to get control. So strategically, he was positioning himself for strategic control, not because of anything. He wants to be on the board of that company. That's his aim. That's his reason why he is investing. And many more why entities will invest. Now, when companies invest, you see, these investments can either be in debt instruments or equity instruments. That's how they invest. The focus here is on equity instruments. I already taught you debt instruments in IFRS 9 and IAS 32. So here I want to teach you equity instrument. So the focus here is equity instrument. And when entities invest in equity instruments, it can result into these types of investments. When you buy shares in another company, it can result in these types of investments. Number one, your investment can become an investment in subsidiary, or your investment can become an investment in associates. Or your investment can become, let's call it financial assets, which is the one of equity investments. So our focus for group accounts is majorly investment in subsidiary and investment in associates. I have already taught you financial assets under IAS 32 and IAS 9. I said IAS 9, IFRS 9. I've already taught you that. So today, we want to go a little beyond that, which is investment in subsidiary and investment in associates. We will use the following standards to account for investment in subsidiary and investment in associates. Number one, we're going to look at some sections of IFRS 3 on business combination. We're also going to look at IFRS 10. I'll be extracting some section from there on consolidated financial statements. We're also going to look at IAS 27 on separate financial statements. Also, we're going to look at IAS 28 that deals with investment in associates and joint ventures. Also, which other one? There are other standards like IFRS 11, joint interest, or IFRS 13, fair value measurement. But that basically you will not cover. So these are the 4 standards that I will be using to teach you investment in subsidiary and investment in associates. So let me just give you an introduction to investment in subsidiary. Since we have established that those are the 2 we want to look at. So we said that when you buy equity interests in another entity, and when I say equity instruments, I mean ordinary shares majorly. When you buy shares in another company, we said it can result in any of this that we mentioned earlier, either investment in subsidiary or associates. And when can you buy shares in a subsidiary? At what point can it result in an investment? Now you call that investment an investment in subsidiary. So investment in subsidiary, in fact, acquisition of ordinary shares, or let me call it equity interest. Let's get used to call it equity interest. It's the same thing as say acquisition of shares, ordinary shares. Equity interest is the same, right? But equity interest seems very direct. So acquisition of equity interests in another entity or in an investee. In fact, let me call it in an investee, so that you know that me, I'm the investor then the target company is the investee. So acquisition of equity interest in an investee will result in an investment in subsidiary where the entity's holding in the investee is above 50%. So when you are buying equity interests, meaning shares in another company, it will result in an investment in subsidiary where your holding in the investee is above 50%. So when your holding in the investee is above 50%, that's your investment. You call it an investment in subsidiary. And very importantly, this type of investment gives control to the investor. It gives control to the investor. Now, I need you to note something. Note this, that however, an entity can also have control without holding an equity interest in the investee of over 50%. All you just need to show is that he has control. If you can show us that you have control, even without 50%, that's fine. So we will get to all of these points very soon. I will explain all of that here. So like Otedola now, because I'm mentioning that because it's recent and it's all over the news, so you can easily relate to that. So like Otedola, for example, now, you agree with me that he is the chairman of the bank now, which shows clearly that he has control. He has control, literally, even though he doesn't have 50% holding. He doesn't have 50% holding in the equity interest of First Bank, but he can show that he has control. So we would see how that is possible. And I want to believe that you understand what I mean by 50% holding. It means that if the total ordinary shares of the company, of the investee, is 100 shares, it means that you must have over 50 shares to have 50% holding of those shares. That's what I mean by 50% holding. So the key word here then is control. When you say you have control, don't think it twice. That your investment is an investment in subsidiary, because that's what signifies investment in subsidiary. Control. That's your investment. It's an investment in subsidiary. That's what you call it. So you see, when we say control, an investor has control over an investee if the investor has exposure or rights over the variable returns of the investee from its involvement with the investee and has the ability to affect those returns through its power over the investee. Even though I can conveniently write this from my own heart without looking at any handout, you should be able to do that, even though it's not compulsory that you have to do that in the exam. They might not necessarily ask you to define control. I haven't seen it in a while. And they can ask you. So it's not bad knowing it. But one thing is clear. When we say control, we are saying that an investor has control over an investee if the investor has exposure or right over the variable returns of the investee from its involvement with the investee. Exposure or right. Exposure or right over the variable return. Variable return is the money made by the investee, the money the investee is making. So from this definition, when I say element of control, the first thing is exposure or rights over the variable returns of the investee. That's the first element of control. And it's because of your involvement with the investors, because you are involved with him. That's why you are having this exposure right. I will still get to this, what gives you this type of right, because right means that whatever money they make is your own. It might not be your own entirely, but you have access to that money. You will get from it. And secondly, is that he has the ability to affect those returns through his power over the investee. That means the second is power over the investee. So another element of control is power over the investee. And third is the ability to use the power to affect the variable returns of the investee. These are the three elements that signifies control. If I want to break down this element of control further, then I think it makes sense to start with this power. Because yes, you have a right to variable returns from involving with them, from the fact that you have shares in them. But from what I'm seeing here, the fact that you can affect that return because of your power. What's that power? What's that power? So this power, we can say this is the existing rights. Existing rights that gives the investor the current ability to direct the relevant activities of the investee. Existing rights that gives the investor the current ability to direct the relevant activities of the investee. That's the power. So the power is in these rights, existing rights. So what are these rights in question? What are these rights in question? Before I go to the rights, I can see a hand up. So can you please ask your question before I move on?
Sorry, sir. Hold on for the class. Sorry, just want to understand this. The investee is the one that have less shares, and the investor have shares more than 50%. I'm trying to understand the parent company and the subsidiary. I don't know. Because the investor is kind of like trying to. I don't understand it clearly, sir.
Because you're already above this class. I've not even
No,
mentioned
sir.
it like parents all along. Neither have I mentioned. You're already
no, sir.
above us.
No, sir.
Why don't
I'm
you
not
come
about
to
this.
our level so that you can get it? I think you should follow as we are doing. I haven't said anything out of the ordinary yet today. I haven't said anything ordinary. Those questions you are asking is going over the simple things I've said so far. If you are following systematically as I'm doing it, you would understand what I've said so far. Don't go beyond that for now, because I'm going to
Okay,
get to all of those places. Very, very,
okay, okay, okay.
yes.
Thank you, sir.
Yeah. Okay. So I'm sure everybody knows here that when we say investee, it means the company you are buying. That's what we call an investee, the company you want to acquire or the target entity. That's the investee. So I'm trying to paint a sequence to make you understand everything that you need to understand in a very apt manner without wasting too much time on this. As I was saying, I moved from intercorporate investment to how you do that through debt and equity. And we said, what we want to look at here is equity, because I've taught you debt in IFRS 9. And we say, okay, when you buy equity, it will result in these three types of investments: investment in subsidiary, investment in associate, and financial assets. And I said, I'm not taking you financial assets here because I already taught you under IAS 32, IFRS 9. If you're not in class that time and you can sit down to watch that video, it's as good as you're in class. And we said, okay, since what we want to learn is investment in subsidiary and associates, these are the standards we will use. I highlighted 4 standards, and truly these are the standards I will use to teach you. Then I introduced investment in subsidiary, trying to explain when I say that you buy shares and that your investment can be called investment in subsidiary. I said it's because you're holding in equity interest of that that investee is above 50%. So if I buy shares in another company, which is an investee, and my holding is above 50%, that my investment is described as investment in subsidiary. And this type of investment gives the investor what we call control. And I painted a very important caution that control can also happen even without having over 50% holding. It's possible. And I give you an example of a $10. Now, I narrowed it down to control. I gave you a definition. Now, I'm trying to break down that definition into its core elements. There are 3 elements there. I picked the one that explains everything, that connects everything together, which is power. And this power is the existing right that gives the investor the current ability to direct the relevant activities of the investee. Now, the existing right itself is what gives the power. It's what gives you the ability to direct their relevant activities. And relevant activities is whatever it is they are doing, whether they are selling goods, whether they are providing services, whatever they are doing is their relevant activity. So what gives you that right? What gives the ability to direct those activities is the right. So what is this right? Okay. So these rights could either be obtained directly through voting rights, by buying equity interests in the investee of above 50%. So this right can either be directly through voting rights by buying equity interest in the investee of above 50%. It gives you that power. Or it could be indirectly. These rights exist where the following, where the investor can do the following. Number one, where the investor can appoint, remove, or reassign key management personnel of the investee. When you can do this, it shows that you have power. Shows that you have control. When you can appoint, remove, or reassign key management personnel of the investee, you are powerful. Or when you can appoint, remove, or reassign an entity that directs the relevant activities of the investee. So is either you can appoint key management personnel, or there is an entity, maybe a company, that directs their relevant activity. You can appoint them, remove them, have power over that investee. Also, when you can direct the entity to enter into transactions in the favor of the investor. You can direct them to enter into transactions in your favor. You have power. Or carry out activities carry out activities in line with a management contract that is signed between you two. This can also signify power. So what we are saying here is this. I started from control, and the key element of control is power. What shows that you have control is power. It's beyond just holding of shares. And this power is that right that gives the ability to direct the relevant activities. So that right, you can either get it directly by buying shares, by buying equity interest in the investee of above 50%, or you can get it indirectly. If you can show this, if you can do any of this, if you can do any of this, you can fire, you can appoint key management personnel or appoint the entity that directs the relevant activities of the investee, or you can direct them to enter into transactions in your favor. You have power. Okay. So when we talk about investment in subsidiary, what I need you to know is control. When you have control over an investee, then you have investment in subsidiary. And this control basically is because you have right over their returns because of your involvement with them, and you can affect those returns because of the power. So that power arises either because of your holding in the company of above 50%, or because you can remove and hire powerful people that direct the relevant activities of the company. Then you have power over that investee. So when an entity has an investment in subsidiary, the entity is, or let me say, the investor is known as the parent entity, while the investee is known as the subsidiary entity. So parent and subsidiary can only arise when you have an investment in a subsidiary. That's the only scenario where you are known as the parent, while the other entity is called subsidiary. Secondly, introduction to investments in associates. So investments in associates will arise where an investor acquires equity interest in an investee and its holding in the investee is between 20% but less than 50%. It's between 20% and 50%, but it should not be up to 50%, less than 50%. Then that is an investment in associates. This investment will give the investor significant influence over the investee. Gives the investor significant influence over the investee. Note that it is possible to have significant influence without holding equity interests of up to 20% in the investee. It is possible for you. You just need to be able to demonstrate some things to us. But when we say investment in associates, it's because you bought shares in an investee and your holding is 20, it cannot be less than 20%. It's 20%, but less than 50%. It doesn't have to get to 50%. If it gets there, that's not associate anymore. It's something else. See, this investment would give the investor significant influence over the investee. You can have significant influence without holding up to 20%. It's possible. Now, before I move on to significant influence explanation, I saw a hand raised up. Can you please ask a question? Okay, I guess he has changed his mind. So when we say significant influence, see, this is the power to participate in the financial and operating policies of an investee. When you can participate, you can just participate in their financial and operating policies of that investee. This power can arise directly through voting rights by buying equity interests of 20%, but less than 50%. This power can also arise indirectly from the following. Number one is where the investor provides essential technical information to the investee. It a show that you have significant influence when you're the one providing them the technical information they need to operate as a business. You are giving them, you are the one that is responsible for giving it to them. It's a show of that you have significant influence. Also, is where there is exchange of key managerial personnel between the investor and the investee, where there is exchange of key managerial personnel between the two of you. Top management personnel it also shows that you have significant influence over the investee, or where there is material transaction. You guys are consummating material transactions. And when I say material, it means that it can determine the survival of the investee. So when you guys carry out material transaction between the investor and the investee, it also shows that you might have significant influence over the investee. Also, where the investor is represented on the board of directors, you're on the board of that company, you have representation there. It is a sign that you have significant influence, even if you don't hold up to 20%. Or where the investor participates in the financial and operating decisions of the investee. It shows that you have significant influence. So any of these can also show that you have significant influence over the investor. You see, where an entity has an investment in associates because of what I've mentioned above, the investee is known as an associate, while the investor can simply be referred to as an investor or parent, but this is arguable, right? Because you're a parent if you have investment in subsidiary. We just call you an investor if you have investment in associate, but you find questions calling them parents like that. So it's fine. So that's the introduction to investment in associates and investment in subsidiary. The only thing I've just want to have comfort that you have learned so far is control and significant influence, because that's the most important thing I've mentioned. under this investment in subsidiary and investment in associate. Then later you can learn all these definitions and all that. And another very important thing I've mentioned here today is the fact that what gives control is this power. And what brings up this power are these rights. And these rights can either be gotten directly, where you buy equity interest in the investee of above 50%, or indirectly when you can show the following. The same thing for associates. We're talking about significant influence. This significant influence can either be gotten directly through your holding in equity interest of 20% but less than 50%, or indirectly when you can show any of these five. It shows that you have significant influence. Now, I will start with subsidiary. Then, when I'm done with subsidiary, then I will move to associates. Where an entity has an investment in subsidiary, IFRS 10 requires the entity to prepare a consolidated financial statement. And when we say a consolidated financial statement, is a financial statement of a parent and its subsidiaries. That is prepared as that of a single economic entity. So when you have investment in subsidiary, IFRS 10 says make sure you prepare consolidated financial statement. You have to prepare consolidated financial statement. And when we say consolidated financial statement, so we are talking about you preparing financial statement of the parent and its subsidiaries. Even though for you guys, I'll be teaching you a situation where the parent has only one subsidiary. But we want to prepare it as if it is that of a single economic entity. So basically, that's what we just want to do. How to prepare those draft financial statement as if it is that of a single economic entity. So we'll show you how to do that. Hopefully, starting from today, I would show you how to achieve that. Okay. Now, before we go ahead to prepare these consolidated financial statements, there are certain points, there are certain keynotes that the parents usually take into consideration. And the very first of it is what we call potential voting rights. Potential voting rights, PVR. So these potential voting rights, these are instruments that can become ordinary shares or equity or equity in a future period. So this must be considered. These instruments must be considered in determining whether an investor has control over the investee. Because don't just look at Shibi, we have 50% holding now, so I have control. We have more than 50% holding now, so I have control. You need to ask, are there any potential voting rights? Are there people that we have given options to? Are there people that we have given warrants to? Are there people that have convertible bonds? These are instruments that can become ordinary shares in the future. You need to consider that now to know whether you have control or not. Because by the time those people convert, it can convert your over 50% voting rights to less than 50%. And you might lose control. So potential voting rights should be considered in determining whether an investor has control over an investee. Another one is exemption from preparing consolidated financial statements. So there are some exemptions that are permitted under which the parents might not prepare consolidated financial statement. So you need to consider this before you go ahead and prepare that. Do you fall under this exemption? Do you want to claim it? And it's not compulsory. It's an optional exemption that you might want to key into. What are these exemptions? Number one, where the parent is also an wholly owned subsidiary, meaning that the parent also has a parent. You're a parent, right? As a result of you having investment in subsidiary, but you yourself, you have a parent. You're exempted though, if you wish. Or it is a partly owned subsidiary and its other owners, including those who are not authorized to vote, do not object to the parents not preparing consolidated financial statements. Is long, Abi. You can just stop here and leave these other ones for them. But the point is this: the parent itself is an wholly owned subsidiary or is partly owned. Okay, it's partly owned. And its other owners, meaning the other people that own that parent itself, they don't object to the parent not preparing consolidated financial statements. They are not objecting to it. That because they believe that another person will prepare it. So in such case, he is exempted from consolidated financial statements. Also, it is not a listed entity, meaning the parent is not a listed entity. Or you can say its shares is not in the process of being listed. That is not a listed company, or its shares is not in the process of being listed, you are exempted. You don't have to prepare consolidated financial statements. And also, its ultimate parent entity, will prepare consolidated financial statements that complies with IFRS 10. So if any of these exists, you're exempted. You don't have to prepare consolidated financial statements. Leave the stress to your ultimate parent entity. Let him do the preparation. You don't prepare. Another one is exclusion of a subsidiary from consolidated financial statements. Can you exclude a subsidiary from consolidated financial statements? So a parent can only exclude a subsidiary from consolidated financial statements when the subsidiary or when the parent loses control over the subsidiary. So you can only exclude or remove a subsidiary from consolidated financial statements when you lose control over that subsidiary. So the major thing here is loss of control. So this is intentional because there are some companies that before now they will just exclude a subsidiary from consolidated financial statement just because they want to, or because they believe the subsidiary is a loss-making entity, or the subsidiary would not make their financial report looks presentable. So they will exclude it. Now, with this standard, that's not allowed. You can only exclude a subsidiary when you lose control of that subsidiary. Another one is uniform accounting policies. The subsidiary and the parent must have uniform accounting policy before you can consolidate The parent and the subsidiary must have uniform accounting policies before the parents can prepare consolidated financials. If the parent and the subsidiary does not have uniform accounting policy, that means the subsidiary should adjust his financial statements to align with the accounting policy of the parent. He should update his accounting policy to align with that of the parent. Because if they don't have uniform policies, we cannot prepare consolidated financial statements. Then we have uniform year-end or uniform reporting dates. So the parent and the subsidiary must have the same reporting dates. However, where this is not possible, they can go ahead and prepare consolidated financial statements if the difference in reporting dates is less than 3 months. So the parent and the subsidiary must have the same what? The same reporting dates. If this is not possible, meaning that their reporting dates are different, the parent can still prepare consolidated financial statements where the differences in reporting dates is less than 3 months. However, before the parents can prepare consolidated financial statements, adjustments must be made for significant transactions in the books of the subsidiary. So we need to make some adjustment for significant transactions for the books of the parent. So we expect them to have the same reporting dates, but if that is not possible, they can go ahead, provided the differences in reporting date is less than 3 months. So we need to then ensure that we make adjustment for significant transactions between those dates, just so that all major transactions still aligns to the parent reporting date. All major transactions still aligns to the parent reporting date. So if you have to, because everything, if the parent reporting date is December and your own is March, you can still consolidate, but you need to make some adjustments in those your 3 months extra statement that you have. We need to adjust for significant transactions there, because what we want to see is the position of the group as at the reporting date of the parent. That's what we want to see. So these are just preliminaries that you need to take note of when you're preparing consolidated financial statements. Okay. Let's take some questions before I move to the next, which is how do you prepare this consolidated financial statement? So if
My
you have
hands is up, sir.
okay, please ask questions, Lati.
Thank you, sir. Just to get it clear, sir, you said even that the difference between the reporting date of the parent and the subsidiary are not the same, that they can still go ahead and prepare consolidated financial statements if only and accept the reporting date is less than 3 months. When you say less than 3 months, it means 2 months and 1 month. Am I clear, sir?
It
Or
could be
maximum of 3 months.
yes, maximum of 3 months. So it cannot be more than 3 months like that. Any other questions?
Yes, sir.
Okay.
So, sir, how do we identify the significant transactions that we are to adjust if the reporting dates are not the same?
It's a matter of judgment. The standard didn't tell us how you identify that. So it's actually a matter of judgment from the standpoint of the parents and the subsidiary when they are making those adjustments. So we really don't want to dabble into all of that, really. But it's a matter of judgment. So I think I have taught you IAS 10. Yeah, IAS 10, eh? So these significant transactions, yeah, if you still remember what I taught you in IAS 10, these are they are really referring to adjusting events. Adjusting events that those events that occurred after the reporting date that are indicative of condition that exists at the end of the reporting date. Like if the subsidiary has a receivable of 100 million in his books and during those 3 months extra, the difference in reporting date, one of the receivables customer goes bankrupt. So that means we will need to impair, we will need to remove that receivable. So these are majorly adjusting events that you need to use it to update the books of that subsidiary at the reporting date of the parent. It's majorly adjusting events. That's what this standard is talking about, really. Any other questions? Okay. So that being said, I need to mention that before I show you this consolidated financial statements, there's the parent the parent also prepares separate financial statements, meaning that the parent can also prepare his own separate financial statements. Where a parent has a subsidiary, yes, the standard says he should consolidate. However, where either he takes advantage of this exemption that he doesn't have to consolidate, or even when he prepares consolidated financial statement, you know that as a company, you need to also prepare your own separate financial statement. So there is a parent separate financial statement. So in the parent separate financial statements, the investment in subsidiary will be accounted for at costs. So he has to put it in his that investment in subsidiary. He will just recognize it. He will just recognize it in his financial statement at cost, meaning the money, the amount he paid to buy that subsidiary. He will just put it under non-current asset as investment in subsidiary. However, where a parent takes advantage of the exemption from preparing consolidated financial statements, it must disclose the following. Number one, the fact that its financial statements is a separate financial statement, and it has taken advantage of the exemption from consolidated financial statements. Number two, the name and country of incorporation of the entity that prepares the consolidated financial statements, and the address where those financial statements can be obtained. So when you are taking exemption from preparing consolidated financial statements, you have to disclose the name and country of incorporation of the entity that prepare that consolidated financial statements, and the address where those consolidated financial statements can be obtained. Also, the list of significant investments in subsidiaries. You need to tell us all the investments in subsidiary you have made and the description of how those investments are accounted for. You need to tell us how those investments are accounted for. So if you're doing a separate financial statement, all these are required. I've seen I can ask you this before for 3 marks, so it's been a while though, but it's something they can actually ask. You see, all of these things that I'm writing by heart, you must be able to also write it like that because you are the one writing the exam, not me. I'm just showing you that it's actually possible. You should be able to do it as well. Now, finally, you will hear me mention group a lot. Group. And a group, when I say a group, I mean this refers to the parent and its subsidiaries. Finally, is the content of consolidated financial statements. So when you pick up a consolidated financial statements, these are the contents. Number one, you will find the parent separate financial statement there. You will always find it in the consolidated financial statements. Number two is the consolidated statement of financial position. Number three is consolidated statement of profit or loss. Number four is consolidated statement of cash flows and notes to the financial statements, including summary of significance accounting policies. Okay. So I'm done with that introduction. Then how do we then consolidate? So how do you consolidate? So the consolidated financial statements is prepared using what we call a consolidation method. Call it a consolidation method. And this involves two things. Two things. You cancel out items that appears as assets in the books of the parent and a similar item appear as a liability or equity in the books of the parent and vice versa. So consolidation involves, you just want to ensure you cancel out items that appear as assets in the books of the parent and the same item appear as a liability or equity in the books of the parent. You cancel them out. And secondly is that you combine or add together the remaining items that were not cancelled out. That is all we want to learn. But before I look at items, examples of items, that are cancelled out. Number one, the carrying amount of investment in subsidiary in the books of the parents should cancel out against the equity of the subsidiary. So the carrying amount of investments in subsidiary in the books of the parents should cancel out against the equity in the books equity in the books of the subsidiary, because they are the same item. So we don't consolidate that because we believe they are the same item. So you cancel out. Those are examples of items you cancel out. Another one is
Sorry, sir. If from what you just did now, does it mean that first note you gave us, canceling out items that appear as assets in the book of parents? The other one, is it not supposed to be subsidiary? It's still parent.
Lukman Umashe.
All right, sir.
Thank you, Lukman. That means you are following. Yes, sir. In the books of the subsidiary. Yeah, I'm sure now that somebody is following. Another example is that where the parents buys goods from the subsidiary, you need to cancel out the trade receivables and trade payables in their books, respectively. So, because they are the same item, where the parent buy goods from the subsidiary, you might find one of them having trade payables and another having trade receivables you need to cancel this out in their books. And a lot more that we are going to learn, but let's just start with these very simple ones. So now we can start solving questions. Then more explanations will come up from there. Okay, can we hear another person's voice? I've been the one talking for the past 1.5 hours. Is Femi around?
Good evening, sir.
How are you?
Fine, sir.
Okay. I can hear some noise in the background, though. I think you might not be able to.
Okay, sir.
Yeah. Okay. Is there another person that will be able to read for us?
I can take the reading.
Okay, Vivian. Go ahead, please.
Okay. Alpha Limited owns 40% of the voting shares of Beta Limited. The remaining 60% is widely held by other passive investors, none of whom own more than 5%. The third point, Alpha Limited also holds a call option to purchase an additional 30% of Beta Limited's voting shares. Fourth item, the call option is exercisable at any time, is deeply in the money, and expires in 3 months. Fifth line item, Beta Limited's key decisions are made by simple majority vote. Then the last, Alpha Limited is also entitled to appoint 3 out of 5 board members. Questions. Does Alpha have power over Beta? Number 2, are they the potential voting rights, PVRs, substantive? Number 3, does Alpha have exposure to variable returns? And number 4, can Alpha use power to affect returns?
Thank you very much, Vivian. So if you look at this question, the first requirement is, does Alpha has power? So when we say power, is either directly through holding of more than 50% or indirectly where you can either appoint or remove people that has the direct relevant activities. You can appoint or remove entities that direct relevant activities of the company and all of that. That's power. And from here now, this company has 40%. So it doesn't have control if you are judging from voting rights. But the remaining people that have 60%, they are widely spread around, meaning none of them has more than 5%. Like no one person has, so you have 40%, right? And Alpha holds a call option, which means that it can buy additional 30%. And this call option is deeply in the money, which means that he will exercise it, which means that it is attractive for him to exercise. So Beta makes key decision by simple majority votes. That means this guy has majority votes. And Alpha can appoint 3 out of 5 board members. It's finished. What's it on? So then I said, does Alpha have power over Beta? Yes, it does. Yes, it does. Because it has a 40% holding plus a 30% PVR. And remember, I told you that when you want to know whether you have control, you need to consider potential voting rights. This guy has potential voting rights. So he will be considered. So he has power. Additionally, it can appoint 3 out of 5 board members. He has power. Is the voting rights substantive, meaning that will it crystallize? Yes. It will become ordinary shares. That is substantive. Because it is attractive to offer to exercise the option. So that's what we mean by deeply in the money. It's substantive. It will become ordinary shares. It will definitely become ordinary shares because it is deep in the money. Does Alpha have exposure to variable returns? Yes, he has exposure because it has voting rights or equity interests of 40%. So he will get returns. Can he use his power to affect those returns? Yes, because it has control. He can use that power because he has control. Additionally, key decisions in Beta are made by simple majority and Alpha can appoint 3 out of 5 board members. So all this is just revising what you have learned so far. Vivian,
Yes, sir.
read illustration 2.
Okay. Zeta Group is a public interest entity preparing consolidated financial statements under IFRS. It owns 100% of the equity shares in Omega Limited, a wholly owned subsidiary incorporated in a foreign country. Omega Limited, the first line item. It has been placed under long-term government receivership due to regulatory violations. Second line item, the government-appointed administrator has full control over financial and operational policies. The third item, Zeta Group has no access to financial information, cannot appoint board members, and is legally prohibited from directing the entity's activities. Fourth line item, the receivership is expected to last indefinitely, and Zeta Group no longer receives any returns from Omega Limited. Based on the above facts and FIRS 10, should Zeta Group consolidate Omega Limited in its consolidated financial statements Justify your response.
I'm sure everybody here in this class knows the answer. Because even though this guy, Zeta, owns 100% of Omega, unfortunately, Omega has been placed under receivership due to regulatory violation. Now, they have appointed administrator that has full control over financial and operating policies. Zeta does not have financial information. It does not appoint board members. In fact, it is legally prohibited to direct the entity's activities. And unfortunately for Zeta, this receivership will last indefinitely. The guy even no longer receives returns. Yeah, what a wasteful investment. So, from all the points in the question, it indicates clearly that Zeta. Yeah, Latif, go ahead, please. You can ask a question.
So I want to, after you are through with the solution, sir.
All right, sir. Okay. It does not have control over Omega, and therefore cannot consolidate Omega. In its consolidated financial statements.
Okay, sir. Thank you, sir. Sir, in a real life scenario, sir, if this story of Zeta and Omega is a real scenario, is there any way out, or that is how just the investment will just saw it, just wasted? Or is there any way out for the Zeta?
There's no way out now. There's even a real life scenario that happened recently now. Union and Titan Trust Bank. Titan bought Union control when Tinubu people came. They said it's government money they used to buy it. There's regulatory violations and all of that. They appointed somebody that took over Union. Today now, it's gone. They are now Union now. There is no way out. It's regulatory. There's nothing they can do. Government is powerful. Okay.
Okay.
Vivian,
Yes, sir.
next illustration, please.
Alpha PLC has a 100% owned subsidiary, Beta Limited. Alpha's reporting date is 31st December, but Beta prepares its financial statements to 30th September due to local regulatory requirements. The financial statements of Beta are not adjusted to the group's reporting date. Can Alpha PLC consolidate Beta Limited without adjusting for the difference in reporting dates? What are the requirements under IFRS 10?
Okay, good. So I think I mentioned this, right? So Alpha has 100% ownership, 100% owned subsidiary Beta. So the parent's reporting date is 31st December. The subsidiary is September. But due to regulatory requirements, so the financial of Beta are not adjusted to the group reporting date. So can Alpha consolidate without adjusting for the difference in reporting date? So yes, it can consolidate without changing the reporting date of the subsidiary. And this is permitted because the difference in reporting date is not more than 3 months. However, before it can consolidate, adjustments must be made for significant transactions in the books of the subsidiary. So adjustment must be made for significant transactions in the books of the subsidiary before they can go ahead and consolidate. So even though, yes, you don't have to change the date of the subsidiaries because the differences in reporting date is not more than 3 months. But before you can consolidate, you have to adjust significant transactions that occur between that 30 September and December before we can go ahead with the consolidation. Okay, next illustration, please. Vivian.
Delta Group owns 80% of Epsilon Limited, which uses the revaluation model for property, plant, and equipment, while Delta uses the cost model. Epsilon's financial statements are prepared using its local GAAP, which has not been aligned with IFRS. Can Delta Group consolidate Epsilon Limited without adjusting Epsilon's accounting policies? What does IFRS 10 require in this situation?
So Epsilon cannot consolidate. Epsilon. Delta cannot consolidate the financial statements of Epsilon without adjusting Epsilon's accounting policies. So they will need to adjust the accounting policies of Epsilon to align with the parent or with Delta's accounting policies. It might even be more detailed because I can see that this guy does not even use IFRS. This subsidiary, he uses this epsilon uses its local gap. That means they will even need to convert from that local gap to IFRS first, not just accounting policy, but because they are asking for accounting policy, so let's just give them a very simple answer. Okay, let me allow you guys. I'm going to stop here. Tomorrow evening by I think 7. Yeah, 7. We'll start solving questions. They are actually very easy. It will not take us time at all. So I have big plans to solve as many questions as possible, so that, and also practice past questions as well on all of these consolidations. The consolidation thing itself is very straightforward, so we'll be very fast tomorrow. When we come at it, we would look at it, so that by when we meet in the next class, we'll have finished. We'll move to some adjustments, intra-group transactions, and all of that, which we are going to finish. And as soon as we are done with that, that's it for group accounts. There's really nothing special around it. So we'll just probably move to statement of profit or loss. Then we'll move to associates. Then also I'll solve a past question. Then I'll teach you statement of cash flows after that. After that class, I'll teach statement of cash flows. And I'll also teach you consolidated statement of cash flows, because there was a day they asked it. So I'll use that particular question to teach you. Then we'll do ratio and EPS. Then that'll basically be it for you guys. And so together we'll sit down together and look at your syllabus, your course outline. Together we'll identify if there's anything we haven't covered. Because what I want to do for you guys in October, hopefully, is to be solving published accounts and past questions together. Because I want us to have finished syllabus. So we'll just come in the evening. Anytime we meet in the evening, we just solve past questions together. That's what I want us to be doing. While you're also asking me questions, if there's any topic you don't understand and you want us to revise, we'll revise and all of that. But we basically have finished everything. And in order to do all of this, as sweet as it is, make sure you're present for the class at 10 o'clock tomorrow. So that's Sunday classes 10 to 12. We really have 2 more classes. I think 2 or 3. I think 3. Just this month. After this month, I won't do that again. In fact, after this month, I will only be meeting you guys once a week. I will only be meeting you once a week. I want to reduce the pressure of classes from October so that you have more time for yourself. That's how to pass ICANN exam, not classes to the end. You won't pass now. You need to seriously sit down on your own and revise and ask questions. So what I want to do in October is past questions, really. Just to solve past questions, and once in a week, just one time. Because I will have finished everything that needs to be finished early enough. That is my hope. And I hope I achieve that. I'll be very happy achieving that. So tomorrow, my aim is for me to teach you IFRS 5 and also IAS 40. If we can't cover the 2, no problem. We'll just do IFRS 5, then we do IAS 40 any other time, which is the next week. Then the next Sunday, I also wish to do IAS 23 and also IAS 20, government grant and borrowing cost. So when I do that, I will only be left with IAS 2 inventory and also IFRS 18, which is a replacement of IAS 1. So I need to tell you the new things that were introduced in that standard. Then that means I'm basically done with all the standards with you. Any standard I teach is JARA, like IAS 24. Now, if I teach IAS 24, it's just JARA for you, related parties. They hardly ask it. It's not even your syllabus, but I just decide that, okay, let's do it. So I mean, we have done so much. I've done a whole lot. And I hope you guys are reading, because it's a whole lot that you have. It's a whole lot to have. So I wish you the best of luck. I'll see you guys tomorrow by 10. Have a wonderful evening. Bye.
Thank you, sir.
Thank you,
Thank you
sir.
very much.